that a margin of slack has opened up in the UK economy and the labour market is continuing to loosen. While we expect it to pick up a little in coming quarters, growth in the UK economy remains subdued. Employment growth is weak and the ratio of vacancies to unemployment has fallen further. Surveys of capacity utilisation suggest growing spare capacity within firms. And here, risks are more to the downside. While real household incomes have risen over the past couple of years, consumption has not followed suit. The saving ratio remains notably above pre-pandemic levels, and we have for some time been expecting it to decline and support consumer spending. Consumers appear to remain more cautious than we have expected, perhaps exacerbated by broader downside risks to activity and the risk of more sudden adverse developments in the labour market. Now, the third key judgment is that the margin of slack will act against remaining persistence in domestic price and wage setting to return inflation to the 2% target in the medium term. While inflation is somewhat higher in the first 2 years of our August baseline projection than in May, a margin of slack in the economy helps fully to normalise pay and price setting dynamics in the medium term. Accordingly, as Chart 4, which has just come up, shows, conditional on the market implied path for bank rate, inflation returns to the 2% target in the second quarter of 2027 in our baseline projection and remains at target thereafter. There are risks on both sides of this projection. The extent of the shift in global trade patterns and how this may come to affect external pressures on UK inflation remains uncertain. Recent domestic news suggests that the risks to inflation have shifted slightly more to the upside. The near-term peak is likely to be a bit higher than we previously expected, and the risk of second-round effects means that it may take somewhat longer for inflation to return to target. But at the same time, there are slightly more risks on the downside to activity. Economic growth is subdued, the labour market continues to loosen, and consumption growth may take longer to pick up. That in turn could lead to inflation falling below the 2% target further ahead. So, do we put more weight on the recent pickup in inflation and the risk it poses to inflation persistence, or do we put more weight on the risk that the recent weakness in activity could lead to inflation weakness further out? Well, the answer is that we set monetary policy to reflect our assessment of the balance of risks, and we set monetary policy in a forward-looking manner to return inflation to the 2% target sustainably over the medium term. That sometimes means that we will be able to look through developments that we think are unlikely to last. But we stand ready to adjust our course if we see shifts in the balance of risks to the medium-term outlook for inflation. And we will do what it takes to return inflation to our 2% target. At this meeting, the Monetary Policy Committee judged that a further 0.25 percentage points reduction in bank rate was appropriate. Based on the outlook for inflation, a gradual and careful approach to the further withdrawal of monetary policy restraint remains appropriate. The restrictiveness of monetary policy has fallen as bank rate has been reduced. The timing and pace of future reductions in the restrictiveness of policy will depend on the extent to which underlying disinflationary pressures continue to ease. Monetary policy is not on a preset path, and the committee will remain responsive to the accumulation of evidence